Usually when we look at markets, there's like a clean cause and effect. A company reports record earnings, their stock goes up.
Yeah.
But looking at the ecosystem today, June 5th, 2026, that basic logic is completely broken. Welcome to today's deep dive.
Yeah, thanks for having me. It really is a wild day on the screens.
It is. And our mission today is to maintain a strictly analytical tone as we unpack, how this unexpected macroeconomic shock is draining market liquidity and what that actually means for corporate treasuries and, well, foundational asset infrastructure.
Right, and to understand why gravity just shifted, we have to look straight at this morning's pivotal May labor report, because the U.S. economy just added a massive 172,000 jobs.
Which is, it didn't just beat the 85,000 estimate, it completely shattered it.
Exactly, shattered it. All while unemployment is holding steady at 4.3%.
And you could really see the confusion before the bell today. Pre-market reactions were mixed at first, but now they are trending heavily lower. So why is a strong jobs report causing a sell-off?
Well, it completely forces the Federal Reserve's hand. With the labor market this resilient, the Fed is basically locked into a restrictive, higher-for-longer interest rate posture.
Right. They just can't afford to lower rates.
No, they simply can't. And when rates stay high, capital stays expensive.
Which brings me to the broken logic I mentioned earlier. Look at Broadcom. They just reported phenomenal earnings, massively beating expectations, but their stock plunged over 12% today.
Yeah, that feels completely counterintuitive, right? Until you look at the hidden mechanics.
So is this like a game of musical chairs where the liquidity music just stopped?
That is actually a great analogy. Think of market liquidity like a tightly stretched elastic band. The Fed holding rates high pulls liquidity out of the system, stretching that band tighter and tighter.
Oh, I see where this is going.
Yeah, and eventually quantitative funds, those big algorithmic players, they get hit with margin calls on their traditional portfolios. They need cash immediately.
They just liquidate their high beta assets.
Right. They go to the easiest ATM available. Because crypto trades 24/7 and is highly liquid, it's the fastest way to raise cash to cover those traditional stock losses.
Wow. And that withdrawal is bleeding directly into the crypto markets. Because of that macro tightening, Bitcoin plunged below major support today to $60,959.
Which is a huge deal, triggering $1.74 billion in automated liquidation.
And those liquidations cascade, right?
So absolutely. It exposes the structural weaknesses inside corporate treasuries that, relied on borrowed money.
Wait, speaking of corporate treasuries, I need to actively push back on something here. I'm seeing so much panic out there today about Strategy Incorporated selling 32 Bitcoin.
Oh, right. The timeline is going crazy over that.
People are acting like they're capitulating under pressure. But we need to clarify this explicitly. That sale was a minuscule 0.0004% of their holdings.
Yeah, it's completely misplaced panic.
And the sale occurred before the STRC price drop, right? It was not forced by current conditions at all.
Exactly. It was just a standard operation. The real problem for Strategy isn't that they sold 32 Bitcoin. It's actually their debt structure.
Right, because of their preferred stock, STRC.
Yeah. Strategy set up their financing with a legal safety net for their investors, a covenant. If their stock drops below $95, which, it just did because of this broader sell-off.
Oh, wow, so they hit the tripwire.
They did. And now they are legally forced to pay a 0.5% higher dividend. That triggered penalty alone cost the firm $53 million annually.
That is a brutal hidden cost. And it perfectly contrasts with a company like Strive or SETA. They are launching a daily dividend model on June 16th.
Right, because they operate with zero structural debt.
Exactly. Since they don't have those encumbered assets or price tripwires, they've built this unbothered 24/7 yield pipeline.
It really shows how dangerous leverage can be, but, despite the spot price chaos today, structural integration with traditional finance is quietly accelerating.
Let's talk about the Ann Arbor mortgage. That is a fascinating development.
It's a major milestone. Better and Coinbase just executed the first ever Fannie Mae-backed residential mortgage collateralized directly by Bitcoin.
Wait, so how does that actually work in practice? How are they doing this?
Well, instead of selling digital assets to afford a house, the borrower locks their Bitcoin with an institutional custodian.
Okay, to cover the down payment.
Exactly. The lender absorbs the volatility risk, and in exchange, the borrower pays a slight interest premium, maybe 50 to 150 basis points.
But they secure a house without ever executing a taxable sale.
Precisely. The underlying foundation is solidifying into traditional real estate.
Even while the surface is turbulent. So, to summarize for you listening, macro pressures are exposing these leveraged corporate vulnerabilities today, but foundational integration is just constantly expanding.
Yeah, it's a really interesting divergence.
It is, which leaves you with a really provocative thought to end on. If you can now use your digital assets to buy a home without ever actually selling them, does the daily spot price even matter to you anymore?
That's a good point.
Or, are we entering an era where it functions purely as an invisible underlying reserve asset? Think about that.